Hi, I'm Brent Farley with Farley Law. I'm the managing member of a law firm that provides regulatory services for banks and financial institutions. And today, let's talk about how to structure a banking as a service agreement or a fintech partnership agreement with a bank. This has become pretty high profile in recent months. We've seen a number of issues arise out of these types of relationships between fintech companies and banks. Some of the relationships are more ingrained than others. Some of the problems that we're seeing are problems with transparency and accountability and how services and products are being handled and marketed to the public and how they're being delivered. We're seeing problems with the commitment to regulatory compliance and compliance with the law. We're also seeing problems with technical capabilities, which is not something that maybe would have expected from a technology firm, but there have been some really inherent basic problems with technology that's been provided. And the last thing that we're seeing is we're seeing problems with how these relationships are being unwound or exited or transferred to other institutions. Some of the relationships are inherently more intertwined than others, and so there's inherent difficulty in unwinding them. Uh, but in a lot of cases, there's been a lack of planning beforehand to allow for that unwinding to happen. So I want to talk about several different types of relationships that you might build between a bank and a fintech organization to offer a product or services or to create one, and some of the advantages and disadvantages of each, maybe a few pointers on how some of the issues should be handled. So I wanted to start with something that's pretty traditional. Let's just start with an investment. So banks can make investments in other companies and even companies that are getting started. And that may be news to some institutions, that may be news to other parties, because banks do have limitations on the types of activities they can engage in. But a bank can make an investment in an organization that is engaged in banking services or the business of banking. And there are multiple statutory and regulatory authorities for this. But in general, what you're looking at is if you have an organization that's going to be providing a typical banking service or something that's very related to banking, and the bank can make that investment, but the investment has to be limited in scope. That is, bank's investment can't be unlimited. There can't be unlimited liability associated with it. And typically, the service that's being created has to advance the bank's operations and activities in some way. That being said, there really are a wide range of investments that a bank can make in other service providers and technology firms, in providing software and providing services to other people. So that's one way to look at creating a relationship with the fintech organization. Now, some of the advantages of that is you can define how much control and negotiate how much control the bank has over an organization or how much it doesn't have. It can define the economic interests. The economic interest might be different than just providing a service because there might be multiples that can be made on an investment. There might be a percentage. There are a lot of different ways that the bank can stack that sort of investment in the company. Disadvantage is the level of risk, right? So if you put money into another organization, the organization wastes it or mismanages it, it's gone. However, if the investment is managed appropriately, the people are capable, the business plan is solid, then there can be money to be made. And the bank does not necessarily need to be heavily involved in providing or developing that particular service. Though that can be an advantage the bank can offer, that expertise and knowledge. And there can be a lot of transparency between the two organizations and how they go about developing and marketing and offering the service. So that's one way to structure a partnership between a bank and a fintech firm, and it can work well. I wanted to mention the investment relationship first because that's a little different than most of the contractual relationships we'll look at with banks and fintech organizations. And on top of that, you can combine an investment in a fintech organization with a service agreement with that fintech organization. So the bank may actually be using the services that it creates, and then that organization can offer those services to other financial institutions or to the public. So it's a different way to stack a relationship. It can help align incentives between two organizations. It can help provide some reporting and managerial accountability. And in terms of exit planning and investment, hopefully if it goes well, you can sell it. If it goes really poorly, you're limited kind of to the investment in the organization and possibly some reputational risk from being associated with it. So in some ways, it's an investment that's more entangling. In other ways, it's more standoffish than entering a service agreement with another institution, in that the exit can be well defined, the investment can be well defined, and the limitations on liability and involvement can be very well defined between the bank and the other institution. So moving on from there, let's talk about just service agreements. So in a lot of cases, if the bank wants to offer a service or a capability, or a technology firm wants to introduce a new capability into the financial services market, that can be introduced by way of a pretty traditional vendor agreement between a bank and a service provider. So if you think about online banking technology platforms are focused on providing sound services to financial institution customers, but also focus on making sure that that service works really well for the bank. The bank can, and the fintech can define the relationship in a contract between the two. And typically in a service agreement like that, you can define, okay, here's how it starts, here's the compensation, here's how it ends, this is how everybody sees what's happening in terms of reporting, and this is how it can be unwind, whether it's turned off or whether there's a transition to an alternative service provider. But in this sort of contractual relationship, typically the bank is very much in the driver's seat as far as saying, we're going to provide these services and these funds and these sorts of opportunities to our customers, and it's going to be facilitated through an agreement with a third-party services provider. That might be marketing, that might be technology services, that might be some sort of referral arrangement, but it's a way to make a standoffish sort of agreement with a technology firm or another firm, so that a bank can better offer its services and capabilities to the public, or to businesses or to consumers or whatever the market may be. So that type of arrangement has been around for a long time. It can be very beneficial and very well controlled. Some of the disadvantages maybe are that the bank does need to be in most cases fairly involved in how that programming is administered. We call that a disadvantage. It's also an advantage because if the bank is involved in the administration of the service, then the bank knows very well what's going on and can manage the relationship in a much better way than I might otherwise do. Another set of relationships that I want to talk about is kind of a program manager arrangement. So this crops up more often in payment services than in other contexts. In payment services like for credit cards or debit cards or merchant services, there are a lot of parties involved in going out and finding customers and providing the payment service and providing the platforms where the payment services are accessed, in clearing the funds and in providing a payments network for all the services to work together. And so what you see happening is you'll see a payment network is typically involved. You'll see a sponsoring institution who ties into the payment network, who does a lot of work in overseeing the relationship. You'll see a technology firm, and you'll see marketing firms that are all involved in this relationship. And then you'll see a program manager step in that kind of coordinates and manages the process and takes accountability for things that are happening. They listed several roles. So, the payment network, a sponsor, technology firm, marketing firm. Sometimes those roles are collapsed or they're kind of mixed. One party might be holding more than one responsibility or more than one seat at the table. One of those parties might also be the program manager. Uh, but the thing is with these arrangements is that typically, because the payment networks have been around for a long time, and these arrangements have been around for quite a long time, is the responsibilities and the different issues that crop up can be well defined and they can be well managed, and liability and responsibility can be assigned to the proper party so that everybody knows what's going on. There's also reasonably well known ways for unwinding these types of service programs. Typically, in a payment service, the framework is in place, but it's not necessarily that funds are embedded in the service all the time. So a lot of times the service only comes into play when a payment takes place, and so if the whole thing goes down the tube or doesn't work anymore, then the payments stop, and it's not necessarily that customer funds are held in limbo somewhere where they can't be accessed. Now, that's not true all of the time, but it's typically a lot more predictable the way that sort of relationship can be unwound. So those are some of the advantages and disadvantages for that particular type of arrangement. And I wanted to move into the one that has been in the news quite a lot lately, besides banking as a service offerings. Banking as a service is kind of hard to talk about because it means a lot of things to a lot of different people. For today, I want to talk about it in a way that we have a financial institution, a depository institution that is regulated, that has an arrangement with at least one other technology services provider, where the technology services provider is really taking the driver's seat in terms of managing the customer relationships. They'll handle marketing, they'll handle technological capability, they'll be the interface with the customer. They're handling so many aspects of the customer relationship. It looks like the fintech provider is providing the service and not the bank. So that might happen in embedded finance. That might happen in some of the novel products and services that are being offered. That might happen in kind of a suite of financial services products that are embedded in a community. Lots of ways to stack that. But we're looking at a situation where somebody other than the bank really is kind of in the driver's seat for a lot of the responsibilities that would otherwise lie with the bank. So some of the inherent problems that come from this are the bank is providing regulated services and has a direct contractual relationship with the customer. However, the relationship is being administered by somebody else that's not the bank. And because of that, in a lot of cases, the bank may not have provided enough transparency and accountability in its relationship with the provider that it can say no to something the provider is doing, or that it even knows something that the provider is doing. It may not be able to see and stop customer relationships as they're being built or occurring. It may not be able to see and stop transactions that should not occur. And so you have this inherent set of difficulties with this sort of embedded relationship that really needs to be addressed on the front end when the bank and the services provider are putting the arrangement together. There needs to be a pretty sound process for customer onboarding, for customer offboarding, for monitoring transactions and services, and understanding how those are delivered. Other issues that we're seeing are the bank has quite a lot of compliance responsibilities, particularly in the consumer transaction context. And so if another firm is tackling almost all the responsibilities with respect to the customer relationship, and the bank doesn't have a backstop for taking care of the compliance issues and the customer service issues, then the bank is kind of at the mercy of the other firm for handling all of those issues. So there's some inherent problems that occur with respect to compliance obligations because the bank is relying so much on another party to take care of obligations for which it is primarily liable. And so if you want to enter into that kind of relationship, you need to be very careful about the capability and the commitment that third party has to compliance systems. You need to be able to know that they're not going to say ready, fire, aim when they offer a new service and not think through all of the issues that might occur. Some of the other things that have hit headlines are, in particular, some reconciliation issues. So technological capability. So if a bank is going to rely on a third-party firm to do ledgering services, to do a customer onboarding process, to handle any sort of technical payments or ledgering or accounting or uh, record keeping function, the bank needs to know that that service provider can handle it. I know we're all human, and so error tends to be just a part of the process. But the technological capability and the way that the system is tested and is maintained and monitored need to be up to par with banking services. It's not like building a video game, where if you're playing a video game and there's a bug and the game freezes and you just have somebody who's frustrated about the game. In financial services, if the financial service doesn't work, usually somebody has suffered a loss and there's a very actionable claim that arises out of that. And often there's a domino effect that happens because of that financial loss. So in the consumer context, if all of a sudden I can't access my funds at the bank, I might have trouble paying rent or a mortgage. And that's a real problem personally. On a business side, I may not have access to my funds and all of a sudden I can't pay my employees. So there's kind of this ripple effect that comes out of errors in financial services transactions that doesn't occur in a lot of other services. And so when you structure a relationship where a third party is taking a very large role, you need to be very careful that that party can effectively deliver the services that it intends to deliver to the other party. Last problem we're seeing is unwinding these relationships. And so typically with a bank, if the bank fails and they have extended loans, so they don't have all their deposits in-house to hand out right away to everybody who might approach the bank to be paid, the FDIC can step in and make the payment to the depositor, at least to the extent of FDIC insurance. And historically, the FDIC will typically go ahead and insure deposits past the FDIC insurance limit. And so there's an existing backstop in regulated entities to deal with a lot of the issues that come with providing financial services. And so if you're dealing with money that's being transferred here and there, or it's being deposited, or it's being lent, there's almost always an inherent risk of liquidity and funds availability in that particular system. And on the regulatory side, there are a number of systems and checks and balances that help address those particular risks in the way that they're managed. And if you're handing that sort of relationship to a third party and you haven't created a similar way to unwind the relationship or transfer it to somebody else, you're going to have a problem. So if you have deposits that are being held through this relationship, provision needs to be made to get the deposits back into the hands of the customer if the relationship goes poorly. You also need to make sure that the amounts of funds that are held in accounts and deposit accounts are being tracked appropriately so that there actually are funds to give back, that everybody knows who has which funds. If you have lending, provision needs to be made for servicing. So if a party goes away, if it has problems, then servicing can be transferred to another institution, or there's a way to allow the relationship to finish out. If there's a payment service involved, it should typically be a little easier to unwind because payments, there's typically a finite period of time where the payment occurs. And so typically the remaining payments in the system can be unwound and then the relationship can be undone. All right, so if you're going to do a banking service agreement, you got to recognize that it's much more involved than the other types of arrangements that we've talked about in this video. And you do need to make provision for transparency and accountability in the system. You need to make sure that there's a very strong commitment to regulatory compliance. And you need to make sure that there's very strong technical capability and some exit planning. Those are really just a few points that you really ought to look at in the banking as a service agreement. But those seem to be some of the key issues that keep cropping up, at least lately. I don't think in our world where services are being disaggregated and offered in a different way, that banking as a service will go away. But there certainly is a painful learning curve that we're watching unfold for some institutions at this point in time. If you are looking at any of these types of relationships with fintechs, between the bank and a fintech, I think they're very doable, just need to be handled carefully and prudently. If you have questions or comments, I'd love to hear from you. You can reach us at banking@farleylawplc.com. Thanks.